Thank you for joining us for our monthly webinar series from Local Market Monitor, where we take a closer look at this month's National Economic Outlook, which was written by Local Market Monitor's president, Ingo Windsor. For those of you that don't know Ingo, he has been analyzing real estate markets for over 30 years and is a graduate of MIT and Boston University. He's not your typical economist and has a knack for taking complex data, extracting what is important, and providing unique insights and tangible guidance on real estate markets. So with that, I bring you Ingo and his insights on the economy.
Thanks very much, Carolyn. Every month, we look at the latest economic data to see what they can tell us about the current state of real estate markets and where those markets might be headed. Our underlying premise is that you make better investment decisions when you have a better idea of the economic forces that affect supply and demand. This month and the next few months, the question is whether the economy will slide into a new recession. And that's important for investors to know, because whether or not we have a recession will determine how quickly home prices will come down. They're coming down in any case. Price bubbles always burst. But if the economy grows well over the next few years, prices will come down gradually, whereas a recession will bring them down much faster. The surge of home prices that started in 2021 is different from booms in the past. Most recently, the boom that started in 2004. So let's first see what happened at that time. Here we see the annual change in home prices measured each quarter from the same quarter of the previous year. The boom began in early 2004, reached its height in 2006, and was over in late 2007, after which prices began to fall. This chart shows the averages for all markets in the country, and the peak price change was about 10%. But many markets at that time had no boom at all. So let's look at an individual market like San Francisco that actually had a boom. Here, the peak change in prices was more than 20%, very similar to what we're seeing today. And the boom was more compact, starting later and finishing earlier, but it was still not as compact as the current boom. Here's what the current boom looks like. It started in 2021, reached its peak of a 22% change in the second quarter of 2022, and is now rapidly fading. The change in the third quarter was 16%, and I'll be very surprised if the change in the fourth quarter is anywhere near 10%. The current boom started abruptly, and I think it will finish abruptly. It wasn't caused by an increase in demand, but by the shrinking of supply in the middle of a pandemic, a time when nobody wanted to move out of their house. That's over now, and the boom will be over too. How quickly it ends and how much home prices will then fall depends on how strong the economy is. The best way to measure that strength is by measuring the growth of jobs, because jobs link directly to demand for housing. But measuring the growth of jobs after a very steep recession isn't easy, because you don't know if you're measuring new growth or just recovery. Here's one way to look at jobs. On this chart in blue is the loss of jobs during the pandemic. In red is the growth of jobs in 2022. It sure looks as though recent job growth has been very good, around 3% a year. Before the pandemic, job growth was only 1.5%. However, we do see slower growth in the last couple of months. Is that just a leveling off, or have we not been measuring the right thing? Here's another way to look at the same data, but this time measuring the growth of jobs compared to the same month of the previous year. This picture shows a slightly different story. Sure, jobs are growing well compared to last year, but if last year was pretty lousy, the apparent strength is really only showing the recovery of lost jobs, not the creation of new ones. This picture suggests we haven't yet reached a real level of growth, and that job growth in the next months will be weaker and weaker. Finally, here's a third view of job growth, showing only the level of jobs compared to just before the pandemic. Seen this way, we've just barely crept out of the pandemic hole. What these different views of job growth tell me is that we're actually still in pandemic recovery, still just putting people back to work, even though they may be different jobs, rather than steaming forward at a good rate. And if jobs are only back to where we started, then demand for housing is only back to where we started, which makes demand highly vulnerable to new shocks. A major reason for pessimism about new growth is that the surge of jobs in business services is slowing down very rapidly. This is one of the most important sectors of the economy, providing services that other businesses need, and therefore a marker of how well other businesses are doing. It powered out of the recession before other sectors did, but the recent trend has been downward, which is especially noticeable if you look at growth from the same month of the previous year. So my conclusion from all this is that the economy is actually not doing that well and will do worse in the next year, even if there isn't a worldwide recession to make things even worse. After that general view, let's take a quick trip through the other economic sectors to see where future growth may come from. Construction made a good recovery and will probably continue to do well with government-supported spending on infrastructure, but higher interest rates will slow private construction. Manufacturing is also likely to do well as more offshore jobs return. And the retail sector continues to add jobs, even though at a very modest rate, because people like to shop at real stores. Finance jobs were boosted by the surge in home buying, but that part of finance will probably shed jobs in the next year. The healthcare sector, on the other hand, will continue to improve as people resume regular checkups and procedures. Although restaurant jobs have increased, there are still fewer of them than before the pandemic, and the rate of recovery seems to be slipping. And jobs in government, mainly local government, are again growing, but at a very modest rate. And this chart makes clear that it will take a long time before they regain all the pandemic losses. That's it. In this time of uncertainty, let me plug our Investors Metro analysis, which analyzes home prices and rents, calculates investment risk, and provides strategic investment analysis for each local zip code. Available for 200 markets, it's written for investors, not economists. Thanks very much for following along. This is our National Economic Outlook. I'm Ingo Windsor.